Sandeep Tandon now joins us. Let's talk about markets and let's talk about where he thinks the market positioning is. Sandeep, you look at market from the behavior standpoint, and the market behavior is that everyone is convinced that we are in a downturn. The slowdown is real. Markets will go down. Nobody wants to participate. And forget about selling on rally. Stocks like Yes Bank and Suzlon and Vodafone are getting hammered despite rallies. What is your current assessment of the market? Do you think the selling is overdone, or this is just the beginning of a long winter?
Okay, so Nikunj, as you know, we look at beyond fundamental also. So our key takeaway right now, both from the risk appetite analytics point of view or the liquidity data which we track on a global basis. Okay, so let's look at the risk appetite first. So in India, our risk appetite, the Quant risk appetite indicator peaked out in January 2018. Okay, and since then it is declining. Okay, and we have seen the risk appetite is actually linked with the slowdown in economy. So if risk indices or risk appetite indicators drifting down, is a clear trend globally also, and so is the case in India. As of based on last month data, it has not bottomed out. So we expect it might take another 2 to 3 months more before it bottoms out. And typically risk appetite indicators are linked with the small cap and the mid caps themes because they are more driven by the risk appetite and liquidity. And let's spend 2 minutes on the liquidity also. So if you really look at India, liquidity also peaked out somewhere in the April 2018 and since then is drifting down. And if I have to look at the global background, globally also risk appetite peaked out somewhere in January and it's still drifting down. But what is more important, the liquidity parameter which actually bottomed out in December 2007. I'm looking at the global liquidity analytics point of view. They have actually inching up. So both from the good liquidity and bad liquidity point of view, which is stimulus liquidity and the private sector liquidity, we believe that liquidity is rising in the developed market as compared to EM. EM still remains soft in the liquidity. So if as a combination, if I look at, so typically market peaks out when liquidity peaks out and risk appetite peaks out, and it bottoms out in the similar manner. But from the Indian perspective, liquidity has started drifting down again from July onwards and risk appetite has not bottomed out, which clearly means if I have to look at from the mid cap and small caps perspective, I think some pain is still left. We are closer to bottom. Maybe another 2 or 3 months time it will take to really bottom out.
This conviction that in 2 to 3 months the sentiment will revive for equity markets. Would it take something from the government's end, perhaps a stimulus, perhaps a rollback of the FPI surcharge, or even some change with the LTCG quantum from 1 to 3 years, etc.? Would it take all of that to really revive and get back the animal spirits back into the economy?
I'm saying even it happens, let's say tomorrow, a lot of expectations are getting built from the government perspective. I think even it comes, let's say this week also, then even it could be a temporary support which market will get. But I think from a medium term perspective, our data point showcase, it's some amount of pain is still left. And if you really look at from a larger perspective, when we talk about stimulus happening globally, because we do track global liquidity very closely. And if I have to break into different components, in a bad component, which is a bad liquidity or stimulus liquidity, what we define is actually started rising from April 2019 onwards. And it is expected to move up further. So even government in India also does something like that. We will not be surprised. So that trend is happening. And we expect that global liquidity will improve further. Maybe emerging market will take few more months before it bottoms out, and everything India is also part of emerging market. Within emerging market, if you look at Brazil is the only emerging market country, if I have to look at Brazil and Russia up to a certain extent where liquidity situation, risk appetite perspective is slightly better. All EMs are largely down.
You say that markets will bottom out in 2 or 3 months. 2-3 महीना बहुत लंबा है. Mid caps can fall 20-30% before the time markets bottom out. So are you saying that 15-20% decline is still left in the market?
If I have to let's say from a broader market perspective, we are seeing some amount of extraordinary shorts of what we measure through a capitulative indicator or the short build-up in the market or fear index in some manner. We are seeing extraordinary short we have seen in Reliance, which rallied. It happened in some of the auto names. Currently, if you look at whether it's Axis Bank, State Bank, extraordinary short, maybe 5 years higher short positions are there. Fear index is just spiking. So some of the individual stocks will start bottoming out, not the broader market in general, because broader market, I think some pain is still left. And maybe stock specific correction is much more rather than generalizing that the entire market can correct 15-20%.
It's a market which is looking very, very fluid, very, very fluid. How does one figure out, Sandeep, that the pain in NBFCs is behind us? What are the indicators which will tell you that it's time to buy NBFCs?
So obviously NBFC and stocks in particular, if I have to again link with risk appetite and liquidity. Okay, these are the two things which drive liquidity, particularly drives NBFC. I don't see that is the case on immediate basis. Okay, the fall may not be very big from these levels, but I think pain is still left in these names. So I will like to avoid at these names at this juncture.
Why do you think you have a depolarization in this market? Asian Paints, Trend, Bajaj Finance. For those who are buying them, the fund managers who are not buying these stocks are criticizing the fund managers who are buying these stocks, saying that you cannot buy good companies at any price. But for those fund managers and those investors who bought these good stocks at any price in last 2, 3 or 5 years, they are the ones who are actually having the last laugh, and they are the ones who are making money in this bear market.
So I agree with you, but if I have to look at our data, if I break the entire Nifty into Nifty 10 and Nifty 40 stocks, remaining 40 stocks, okay, yes, I agree the polarization has reached an extreme level. So if you really ask me, both from the delivery perspective, from the market cap valuation perspective, or the concentration risk perspective, multiple dimensions which we look at from the polarization angle, which we have analyzed this space, and we believe that it has peaked out. So whether you talk about Titan or Bajaj Finance or some of the safer names, maybe Berger and Asian Paint, because of the low oil prices, are still holding on. But most of the stocks have peaked out. So I expect in next 2 or 3 months time horizon, if I have to look at, I think time has come to buy and concentrate more on Nifty 40 stock as compared to Nifty 10, what we have seen in last 3 years.
Okay. Sandeep, given the kind of pain that we've seen and going forward now, I know we've been talking about the general trend, but where do you feel it's wise to park one's money? Would you still look perhaps for value when it comes to the broader markets? Would you completely stick to perhaps safe haven names? What would be the strategy that you'd look at in a market like this, given that there is expectation of the pain continuing for quite a while?
So I think, since I talked about that concentration is now moving towards to the new ideas, and people are trying to identify spaces which are under-owned. I look at classic example, some of the insurance company, both general insurance and life insurance stocks has moved up in last 6 months or 1 quarter in particular. So is the case with some of the asset management companies. These are growth areas from next 3, 5, 10 years perspective. And on relative basis, again I'm emphasizing on relative basis, they are still under-owned. So that's the one area which I think we like to park our money as compared to private sector bank, which is relatively over-owned, okay? And we have seen over-owned status is quite visible in some of the recent correction which we have seen in the market. So there are such certain spaces you have to identify, and some of those stocks also, particularly in the cement space, maybe up to small extent, not metals on immediate basis, but in next 2-3 months perspective, some of the areas you will see value, okay? So I will be more focused on looking at some of these oil marketing companies, maybe some of the power grid or NTPCs of the world. Some of these names are closer to bottom. So I like to look at opportunities next 40 when I talk about, these are the names which we believe will qualify.
Okay. In your mutual fund business, what is the strategy you're planning to follow? Because if you are not sounding that bullish about the long-term prospect, and if you're making a case that there could be a short-term bounce but not a very durable and a sustainable bull market, for your investors, what are you buying? What could be called as a structural theme for 2019, 2020, and 2021? The reason I'm asking you this question is because I've looked at your work in the past, and you looked at identifying these 2, 3, 4, 5-year trends. So what is that 2, 3, 4, 5-year trend which you have identified and where you're putting your clients' money to work?
Okay. So let me just give a perspective. The biggest problem as Indians which we are facing, we are largely one country focused, and particularly maybe a 2 or 3 asset class focused, maybe equity in particular. Okay, we have not really looked at diversification. Given the changes which we expect, because we call this is a wall expansion phase globally from 2018 to 2023, where the global volatility on most of the asset class spike, and in this scenario, that buy and hold strategies will not work. According to our understanding, we are clearly looking at this era is over. Okay, so we have to really look at managing your portfolio in a very dynamic manner, which is not the case. Despite making these statements, it takes time to digest these things. That's the way we are also changing ourselves, and we believe the dynamic way of managing money is the new mantra which I have to look at. That era of buy and hold is over. So if I have to a strong believer, we buy for 10 years, 5 years, we keep on hearing these things in the market. I think that is the strategy which we have to change. We have already changed, and in phased manner we will be implementing completely. Now, if you talked about let's say next 3 years perspective, 5 years perspective, okay. So I said that we have skewed towards life insurance company, whether you talked about HDFC Life or Pru Life or maybe SBI Life. That's the one area we're looking at. Some of the asset management companies which we are looking at from the current levels. And so these are two definite area which we are looking at. Beyond that, if you ask me, some of the consumption names definitely are relatively expensive at these levels, where our dynamic asset allocation model will be much more effective, because we believe that in the current environment, you have to look at these data points very closely. That's the reason we emphasize a lot on liquidity analytics and the risk appetite analytics. That really help us, because we have to look beyond valuations also. So we would like to manage our money in a more dynamic manner, maybe gradually also add global ETFs in our portfolio.
You know, you've said there's still pain left in the broader markets, but you've also said you see it bottoming out in about 2 to 3 months. Give us the kind of worst case scenario, Sandeep, as you see it, and the kind of return potential then, given the dynamic strategy you've suggested.
So if I have to look at the, let's compare from September 2000, October 2018. Okay, that was one of the good bottom which we have seen recently, and then we have seen really significantly 20-25% rally and maybe 40-50% rally in certain stocks also. So if I have to compare, that's the closest thing which we compare. So if all the fear indices which we track or all the capitulative moves is somewhere closer to that, answer is no for market in general, but like stock specific it has come. So I talked about like State Bank or Axis Bank or Reliance or maybe some of the auto ancillary. So wherever we see these capitulative moves, we like to skew our portfolio in these names. And in a year's time, you get 1 or 2 such brilliant opportunity in most of the large caps name where you can shift. So I will like to play this way. I'm not looking at keeping a very large level of cash at these levels, but your stock selection or sector rotation has to be really good to capitalize this move. It's not easy, okay? It's very, very difficult to practice. So I would like to play relatively safe, and whenever we see this capitulative move happening, those are the areas we like to increase our exposure, and definitely not like to keep a very large level of cash even at these level, because we believe that in 2 months time, 3 months time, we are closer to bottom. So we have already started doing bottom fishing rather than just waiting for opportunity to buy at later stage.
Appreciate your time. Thank you for joining us. Hope to certainly see much more of you going forward. That's a special series coping with the sell-off. Sandeep Tandon feels that we are nearing a bottom.